Good morning, everybody, and welcome to the True Potential Do More with Your Money podcast. It is episode 36. It is Friday, the 25th of September. Welcome, everybody. And this week we are going to have our questions and answers session. So, as always, thanks so much to everybody for, I think we had close to 100 questions came in, and we've picked 10 to 12 of the most topical ones for today. So, thank you, everybody, so much for contributing there. If we haven't answered your question, we will try and pick up with you individually as well. So we do appreciate, we do see everything there. To help answer the questions today, delighted to be joined by Greg Lang, by Steve Hutton, by George Bell, and Jamie, back from paternity leave this morning, Sexton. So welcome back, Jamie. Congratulations. All okay?
Yeah, thanks, Dan. Yeah, little bit tired, but I'm getting there. Definitely getting there. But no, little Jack William was born. Little Jack was born on the 11th of September, so it's been fantastic. Absolutely loving it at the minute.
Good one, mate. I'm glad that all's well. I'm glad to have you back. You have to work for a living now again, mate. You're not yet.
I've realised
holiday now, so
I've realised how much babies cost now, actually. So I'm definitely going to have to work for a living.
So you have to work for a long time now, mate. So I think we've actually got a question about JISAs and tax planning for children later on. So we've got a real life case study now.
Definitely.
Yeah. So thank you, gentlemen, for joining me this morning. Before we get into the questions, George, you're Mr. Investment Management this morning. So thanks for joining us, George. Would you mind giving us the normal weekly update, please, mate?
Yeah, of course, Dan. So I suppose this week we've had volatility in the equity and the currency markets. Bond markets in the main have been slightly more calm, and I'll explain why. There's been a lot of attention this week on COVID-19 case counts, policymakers' response in the UK and in Europe. We've had some further probings of the guidance set out by central banks in the UK and in the US last week. But along the way, some positive readings of recovery in many areas and a measured response from government to tackling some of the headwinds. So just painting that picture, coming into the week, we had guidance from Sir Patrick Vallance that the UK COVID-19 case count was picking up. This had an impact on sentiment in the UK and Europe as markets anticipated a full secondary lockdown. By Tuesday, the guidance had arrived, so all hospitality venues now required to close by 10 p.m. Office workers encouraged to work from home where possible. Return of spectators to sporting events postponed and so on. The Scottish Government went slightly further with a nationwide ban on most household visits. So it is a limit on activity, but overall, it was not as severe as the markets were anticipating. So yes, it will change the way business operates, but we know that they are now more able to work in this environment. So in terms of the impact on the economic recovery, yes, it may mean the recovery is moving forward in a slightly lower gear for a period of time, but the expectation is it allows the economy to continue on that path. So there was a sigh of relief from markets, which firmed, closing positively. So you had the FTSE 100 up 0.43% on the day, and in Europe you had the Euro Stock 600 up around 20 basis points on the day. On the data front, in the US, you had further strengthening of the US housing market, with house prices rising 11% year on year. I discussed the UK data last time I was on the podcast, which again was positive. This is important because rising property value has a wealth effect. So people feel more confident in spending, which is really important at this point. We were discussing spending levels in the US with one of our managers last week, who highlighted that spending in the US is now higher than it was pre-COVID-19. So that, amongst other factors, are really things driving indicators of future trends and encouraging analysts around the direction of the recovery. And just to reaffirm that view, on Wednesday, we received the IHS Market Flash PMI data. So that stands for Purchasing Managers Index. The report this week is called Flash because it's only around 85 to 90% of the usual survey sample. So it comes in prior to the confirmed data, but the two historically operate with a fairly low variance there, Dan. The reason markets look out for this is because it's data of higher frequency, which gives it relevance in today's markets. But it also operates to capture levels of business activity on a forward-looking basis. So it's valued by analysts and economists and central bankers because historically PMIs have been a good measure of developments in expected economic growth. So in the US, the data was very positive. It was actually higher than the markets were expecting. So that demonstrated expansion in both the manufacturing sector and in the service sector. We had similar reports here in the UK and in Europe, which were too encouraging, continued expansion in the manufacturing side, but service sectors lagging slightly behind. That's no real surprise given the fact that here in the UK, they were coming from a high base in August. So in August, we had governments incentivising the use of hospitality. We had the Eat Out to Help Out scheme, but we also had a tightening of restrictions at the start of September. So we're coming from a high base, but what we're still showing is expansion in the manufacturing and what you call the headline composite level overall. So that data was well received, but overruling that was the view of investors back on central banks. So back in focus, you had Jerome Powell, who was in front of Congress discussing adjustments which they've made to the support packages which they've issued during the pandemic. So he was really grilled on what you call the Main Street Lending Program, which was set up to provide assistance to small and medium-sized business. It's a huge package. He's offered $600 billion to the channel, but the take-up has been relatively low. It's been less than 1%. So he's been putting in measures to really improve eligibility and access. So getting that money from central banks to the banks and then to the bottom line to business where it's needed. But the key takeout from the session, which is now part of the Fed rhetoric, it's been part of the Fed minutes for the last three meetings, was all about the fiscal package after he painted a more cautious outlook on the pace of recovery and inflation should a fresh support package not come to fruition. But he didn't give the markets the clarity they were looking for on the medium to long-term goals around interest policy and inflation. So that led investors to take some shelter in the US dollar. So the US dollar is up around 1.5% against a basket of international currencies this week. That in itself is really interesting, which we discussed in detail in our morning meetings, because it really reversed a trend which we've seen for several weeks, which was, prior to this point, we had US dollar weakness. So you had the US dollar sterling rate, which has been climbing down from around 134 at the start of the month down to 126 at the start of this week, which inadvertently is very good for international firms listed on the UK and on the European markets. So making export goods more competitive, with the FTSE 100 closing up 1.2% on the day, and in Europe 0.55%. Rolling into Thursday, of course, we had the update from the Chancellor, who replaced the usual autumn statement with the winter economic plan. The furlough scheme, that will come to an end in October. We'll see the job support scheme stepping in for 6 months, which was a really key part of the announcement, along with extensions to the VAT freeze, which came in on the 15th of July, freezing the rate at 5% from 20% for hospitality and tourism sectors until the end of March. We had the restructuring of VAT repayment schedules, which has all really given businesses some room to breathe. So there's a lot for markets to digest in terms of the effectiveness of this program. And in terms of the response, you had sterling advance initially. It went from around 127 up to 128 against the dollar there. In the yield on the UK 10-year government bonds came in around 8 basis points. Equity markets gained ahead of the announcement, but closed down slightly on the day. We can see this morning they are just back in green territory. By the afternoon, the eyes were very much back on the Federal Reserve, as after months of impasse, there were signs that the Republicans would be bringing a revised package to Congress, which they feel will be more negotiable with the Democrats. Closing the differential in packages, it puts them in a bit better position on that basis. So that was a positive reason for the US equity markets overall. So if that's passed, that would mark a significant event. So overall, a lot going on this week from central bankers in terms of data, but some measured data points along the way, and some measured response from government and the key policymakers, which are the ones really making this happen.
Thanks, George. Well done, I think, for kind of summarising in less than 10 minutes what has been a hell of a week. I think there's been a lot to go on. It was only this time last week we were kind of having a bit of a moan, to be honest with you, about the latest local lockdowns, which have affected us in the northeast, which have now kind of moved across into the rest of the country now as well. So you mentioned the Eat Out Help Out scheme. That's now been obviously squashed. That's now the Drink Up and Piss Off scheme. So, so that's a new snappy initiative from governments. But you mentioned about employers closing down as well. So we got the normal couple of hours notice on Tuesday afternoon. So we were into our fourth week of a phased return to work, where our teams were spending 1 week in and 3 weeks out. And unfortunately, 2 days in for one of our teams' first week back in, and they had to go home. So I'll not speak too much on their behalf, but I know they were disappointed with that. They were looking forward to spending some time together. And it's an interesting U-turn. Well, it's not interesting. It's just yet another U-turn from government. And as you say, the only good news out of that, George, was that it looked like markets had already kind of guessed some of this, and they were maybe predicting a harsher lockdown. I think there's still an outside chance. I know we don't make too many predictions on this podcast, but an outside chance we might see what they're describing as a circuit breaker lockdown, probably in about 3-4 weeks' time. It looks like they're trying to maybe wait until we get the half term with the schools, which tends to be about middle of October, and then maybe lock us in for 1 or 2 weeks then. So hopefully not. Hopefully this local lockdown and kind of moderate national lockdown will make some sort of difference here to give a bit of breathing space and a little bit of normality, so to speak. But life goes on, as always, at True Potential. Thus the Q&A side of things today. And as I mentioned in the intro, we got some great questions out there. Maybe what we'll do, Greg, we'll jump across to you first, please. And then we'll then ask Steve and Jamie to pick up the next one. We'll let George rest his voice. So
yes.
The first one, Greg, is about a client. It's I'm just going to say clients' first names today. This is from Phil. And Phil has a pension with True Potential, and he wants to know how he can track how much he's got crystallised and uncrystallised in his pension.
Yeah. Thanks, Daniel. And a good question there from Phil, one that we get quite often. So crystallised and uncrystallised is normally when you took a proportion of your pension as an income, either as a tax-free cash amount, and it leaves you with 2 pots of money in your pension. And often we get the question of how much can I see have I got in which pot? The best way to do this is logging into your client website. So every client affiliated with True Potential has their own unique and secure client portal. Once you've logged into there, you'll have the option to view your pension. And if you would like a breakdown to know how much is in crystallised, uncrystallised, send us a secure message. So again, any client linked with True Potential can send us direct into the team a secure message requesting how much is in each. That goes straight through to a specialist within the team. They will run off the data and they will send you that back the same day. So the good thing about a secure message is we know it's you at the other end. So we're getting you've already passed all of the security. So there's no need to call us up and speak to a member of the team. You can't just get this quickly and securely in your portal. It's a big difference to say what most people are used to when it comes to these statements, because I've got a family member, their pension's not yet with True Potential. They get an annual statement. It's normally 2 weeks out of date when it arrives. So the good thing with us is we'll get the information from the system that day. So you're getting a real-time valuation of your pension and also a breakdown of each of the 2 pots. So for myself, Dan, the best way always is secure message. 1, it's secure, and 2, the team get back to you pretty much the same day. So you're getting it very, very snappy as well.
Yeah, and I think the secure message, I think the hint in the title as well, it's secure. So as you're logging into the site, you're using 128-bit secure socket layer encryption. So and two-factor authentication as well. So that sounds a bit nerdy because it is, but in layman's terms, that's kind of the same sort of security which banks would use out there as well. So it's a safe way of doing it. It's far more secure than email. It can't kind of be intercepted like emails can be. It also can't be cloned, like you see. So sometimes when a lot of frauds tend to happen at times when you see people impersonate email addresses and they try to kind of pick off unawares administrators. So True Potential will always ask you to use a secure message, or if you phone us, they'll ask a bunch of security questions on there as well. What's also good about the secure messaging is it's portable. So it's, you can access it on your laptop via the client website, or you can access it on your mobile device as well. So just I know the question was about crystallized or uncrystallised pension funds, but it was good when you mentioned secure messaging, Greg, because it's something which you can carry around with you in a safe way.
Yeah.
Jamie and Steve, let's stay on the pension side of things. We've got a question from Bernard, which is about pension tax. What tax does Bernard pay on pension payments, both from his private True Potential pension, but also from his state government pension? So, Steve and Jamie?
Well, I'll pass on to the tax expert, Jamie, at this point. The thing to remember, Bernard, though, is that you should utilise your allowances. A pension, obviously, you get generous tax reliefs currently going into a pension, then it grows in a tax-free environment. But the tax you actually pay then is hit when you start to take your money out, as opposed to an ISA that you put taxed income in, but you can have tax-free withdrawals at the other end of it. So my watchword through all of this podcast today will be make sure you do use your allowances, because they ain't going to be this attractive for much longer. As regards what tax you pay on the other side, Bernard, if you're drawing your income from your pensions, I'll pass across to my learned expert, Jamie, on this one.
I think as you said before there, Steve, with ISAs, obviously you're not paying tax on the way out. With pensions, you can phase it in a couple of ways, but you obviously get 25% tax-free coming out of your pension. And typically, you can actually phase your sort of income to come from that tax-free amount if you wish. Or you can do a 25-75% rule where you're paying 25% tax-free. So, and then the other 75% is at your standard rate of tax. What I would say, it really depends on what levels of income you've got coming in. So if you've got, it's effectively a bit like PAYE. So when you're being paid from your employer, your income coming from your pension is treated in the same fashion. I would always say is, if you are looking at starting for the first time in terms of taking out your income, have a chat with your advisor, and they'll discuss about what is the best way to phase it. Because there is for me, I would always look at the most tax efficient way. How can you pay as less tax as possible when taking that income out? And that's not necessarily taking all your tax-free cash, because you do have obviously your allowances as well. So give the team a call or speak to your advisor, and it may just be you just need a little bit of guidance, or you might need full advice on what's the best way to phase it.
I think it's a good point, Jamie, about the tax-free cash, because I think a lot of people kind of see the headline rate at 25% and think it all has to be taken out. It's not the case, is it?
No. I think it's old-fashioned, Dan. I think everyone, from our point of view, you don't have to get to 55 or 65 when you retire and take your lump sum. That's not, that's an old hat pre-pension freedoms. This is, after pension freedoms, it's flexible. If you want to just take 1% of your tax-free cash, you can do that. So just be aware, you don't have to take your full lump sum. And I have many conversations with clients, and they think that they have to do that, and you don't. You can phase it. A pension is such a tax-efficient product, in terms of if you've got an inheritance tax liability, it's exempt from that. So really, before you consider taking any sort of income out of your pension, speak to the advisor. Your advisor really will support you and help you.
Well, I think linked with that as well, I think it's a pension, along with, say, somebody's private property, are probably the largest assets which clients have. And when, and there's a question later on about cash and national savings products, so we'll talk about that in a while. But if you take all 25% of that out, you're losing out on what is a lot of potential growth within there. So and especially at the moment, and George, to stay on this theme, really, there's a question from Tim, or Timothy even, which is, with the pandemic changing the world, are we looking for growth opportunities in new places? Are we focusing on tried and tested areas? Or as ever, is it the normal diversification that we look at? And obviously, George, the reason I'm asking this one is, it's pertinent. Does the client leave as much money in their pension as possible if they don't need all that 25%, to look at the potential growth opportunities?
That's a really interesting question. I think the best way I can sort of look at that is to sort of address what the pandemic's done. I think it's changed the world in terms of behaviour, trend and policy. So setting it out in that way, covering the first 2 points, beneficiaries of the pandemic have been stay-at-home firms. So that's been beneficial for technology and online retailers, which we hold in the portfolios directly with specific names such as Microsoft and Apple, but also indirectly through our managers who gain exposure through indices. So following, say, the S&P 500 in the US, you've got around 24% of that market in tech names. So it's been beneficial. This is an area of the market which has presented strong opportunities in this environment, driven by the requirement to change behavior in the duration of the pandemic, forming a trend in there. So there's one example. In other ways, the pandemic's changed the world for central banks as well. So they were required to step in and support the normal function of bond markets. And to do this, they cut interest rates to historically low levels, and they were buying bonds in the market at levels we've never seen before, which presented an opportunity in return for credit markets, both government and in corporate bond markets, which again, that's been beneficial for the true potential portfolios. But given the magnitude of that shift, with bond yields now at historically low levels, it also presents a challenge. It also presents a challenge in the fact that government bonds are trading at around 0.2% here in the UK for a 10-year government bond, and you're in negative territory in Europe. Therefore, government bonds are no longer necessarily held in a portfolio as a source of return, but held as a source of protection and diversification. So for defensive properties, in terms of new opportunities, going down this path, managers have been moving out towards alternative assets, so carefully building products using derivatives which behaved differently to the equity markets, therefore providing a degree of protection when markets, equity markets specifically, get more choppy. So a number of our managers have been doing this. One example, and I'll just name one being 7IM, have been very successful in doing this. So it's brought around a lot of change in terms of trend and behavior, but it's also brought about a need to think differently in terms of the sources of exposure and diversification, which our managers are active and they are doing so successfully.
Thanks, George. And I think it's interesting what you're saying about low interest rates, bond markets, and things like that. Because we've got a couple of questions for probably Steve and Jamie to kick off with, which is what really to do with cash. So there's a question of Mark about national savings and investments have cut their rates. What should we do if we're holding too much cash? But there's also Jeannie is saying that she's looking to sell a house, but she's not buying a replacement house immediately. What should she do with the cash? And I think just linked with some of the NSI stuff, because we had a question about this a few weeks ago. I've got the email from NSI, so I'll just share some of the figures at the minute. So their direct saver currently pays a current rate of 1%. That's been sliced from 24th of November to 0.15. Income bond from 1.16 to 0.01. The investment account 0.8 to 0.01. The direct ISA from 0.9 to 0.1. And a junior ISA from 3.25% to 1.5. So the exception, even the junior ISA is measly at 1.5 with the new rates, but everything else, that's an absolute shocker for anyone who's got any money in NSI products. So I think kind of Steve and Jamie, what do you do with too much cash? I know it's a problem that you in particular have, Jamie, because you just you're a Scrooge, so you save too much money.
But I think what I would first of all say there, Dan, is you're not even standing still with them interest rates. So you're not even standing still by putting that in there. You're actually losing money. just the saying of a cost of bread now will cost more in a year's time. So the value of money is different. So it's really, I haven't seen them for a while. So that is pretty shocking, them rates that they're offering at the minute. I would always say for cash, you've got to understand in terms of what level of cash that you do need to hold. And we recommend between 3 and 6 months. And I always call this my boiler broke down fund, or I need, something that happens unexpectedly and you need access to your money. But on top of that, then if you do need to look at sort of your long-term saving method. For us, that is investing in something that matches your attitude to risk. That really is truly the only way that you can get some adequate sort of growth. You do have to take a level of risk, and it's understanding what that risk you are prepared to take. But I would say have 6 months in cash, up to 3 to 6 months in cash that reliance and fund, and above that you should be looking at speaking to your advisor and investing that in an adequate risk profile. The question around about selling the property, and I might be buying a property in future. If you're not looking to invest for anything more than 5 years, you shouldn't be investing. It's a long-term investment. You're getting growth over the long term over that period. So if you've sold your house and you've got 6 months before you're going to buy a new house, you shouldn't be investing. You should leave that in cash because it's not enough time to be invested in there. I don't know if Steve's got anything to add to that.
Yeah, I have, Jimmy. I think that was excellently summed up there. I think everybody, when you look at cash, it's not an investment, it's a deposit. And I think you've got to look at human nature. I think when people get scared, they default to something that they see as less scary, less risk. And the perception, I think, out there in the market, not in the professional market that George has very eloquently outlined, is that cash is a safe haven. It is short term, but if you're holding large amounts of cash over the long term, as Jamie has said, inflation will eat away at that, and eventually you'll be losing money, significant amounts of money. I think it was Harold Wilson in my time that first started talking about the pound in your pocket and purchasing power, giving a hint. I can only vaguely remember Harold. I remember he wore a Mac from Halifax. I think it was all right to wear a Mac in those days. I think these days you'd even get frowned at in Halifax. But no, don't be sucked into that false safety net of thinking cash is safe. It's not. If you are living longer in retirement than we were in the 70s and 80s, we're now, people are having 25, 30 years in retirement. Cash is not the way to go forward. You've got to talk to your advisor. As George has talked about, there's so much going on in the investment world. Unless you're a sophisticated investor and you have all the resources and people and access to expert managers that we have, you're not going to succeed. And then you might default to cash as a safety net. It will not help you. It will ultimately lose you a lot of money. So outsource your investments to the professionals, and put your faith in them and trust in them. Build your goals, stick to them. All right, trim your sails on the way. We've said this before, but please don't default and run to cash. It will hurt you. We don't get a lot of clients. We get certain clients who, even in this recent volatility, when we had the drop in March, they defaulted to cash, and then they were stuck there. They were too nervous to get out. And they're sitting on, a significant loss now. Thankfully, it was very few clients because I do think our advisor base and ourselves at head office and all our literature is very good at making people aware that you've got to keep your nerve. As George has outlined as well, volatility has come back to the market in the last week and a half. Not to be unexpected, everybody. Waters are going to be choppy from here, but keep your nerve. And all you have to do to keep your nerve is leave your money invested with the professionals. I do. Not that I've got too much money. I'm from Yorkshire. I'm more of a Scrooge than Jamie, but I leave my money with professionals. I use the technology to watch it, but I leave it with them to invest on my behalf. So cash, not a long-term solution. Please don't be suckered into that.
And any spare cash you have, Steve, you buy Macs with anyway. So
yeah, I do. Yeah, not Apple Macs either, because
not an Apple Mac.
No. Far too newfangled.
Yeah. So flipping from kind of pension and adult savings across to you, Greg, where we've got a question from Joseph, which is asking, do True Potential offer JISAs? But there's also another question then from Mark, which is, should he invest with children in one pot or in separate accounts? So I don't know if you maybe want to cover those off in a one-up, please, Greg.
Yeah, absolutely, Dan. I think a junior ISA is a fantastic product that we've had on the platform for a number of years, and I think over the years our financial advisors have sold these products to the children of existing clients. But more and more recent, it's become a sort of standalone product almost, and not an oversight. So take Jamie for example. When it comes round to his Christmas bonus, he's now got up to £9,000 to put into little Jack's ISA. So what a fantastic allowance to have. It's more than doubled since the last tax year, and we kind of almost didn't hear much about this. It was almost a kind of a under the radar change, but as I say, more than doubling an allowance. And as Steve's mentioned earlier, we really do at the moment have generous tax allowances, so use them where you can. So if your ISA's full and your children's aren't, Jamie, get filling them. Obviously, as everything we've discussed today, they are long-term savings, so it's not there to go in 1 week and out the next. It's a long-term product, but one of the other beauties of it is it's in there until the child becomes an adult. So once they reach the age of 18, it then becomes their product. But at that age, they've already then gained experience to the market. So when we're talking about, the market being it sometimes can seem a scary place. If you've held a junior ISA from, say, the age of 1 up to 18 and you've got some fund in there, obviously it then just becomes second nature to be an investor. So I think there's some really good features within that product. And again, if you're interested, I actually looked at some of our junior ISA literature this morning, which I thought was fantastic, really good read. And in addition, I looked through our tax guide as well, which is very, very friendly. So a lot of the questions we've had today is around, taxation of products and allowances. As you can tell, I'm quite boring and like reading things like that, but it was a good read nonetheless. And I think that leads nicely into the question about multiple accounts. Again, something we see quite often because of the flexibility of our technology, but also the advancements of it. We don't restrict the number of products a client's allowed to have. So if you wanted to have multiple, products, so if you have, for example, 4 grandchildren, you could set up 4 savings accounts. And again, using the technology, you can even name it as each of their names. So you could have the George account, the Jamie account, the Steve account, and the Dan account. And when you log in, you can see them. You can see them all in there. You can also give them individual access if you just want them to be able to log in and see their own. So you've got that group sort of overall net worth for yourself, but then drilling down into each of the sub products. And yes, we actually, if anything, at True Potential, we encourage things like an account for a specific occasion. So rather than just saying, Daniel, you must have all of your investment money in one product, you would be able to break that down and have it for particular saving goals. You can also set different risk tolerances, which is something I know, for example, a lot of clients do, which is they might want one product to be more aggressive and take a bit more risk in the market, but maybe something with a lesser term. So if they need access money for a wedding fund or something coming up sooner, they can bring the risk down on that. So you can have different terms, different goals, and ultimately as many products as you like, which I think is a really great feature of ours that we sometimes don't sort of market too much. So yeah, good question.
Thanks, Greg. No, I think I was just, when you were talking, I was just counting up on my own after. I've got 6 different accounts on my True Potential app, so to speak, and 2 of those are JISAs, 2 for the children in there. It's nicely separated. And what I kind of like about a JISA as well is that once it's invested, you can't really get it out until the child hits 18 as well. Yeah. So it is long-term planning. It can't get raided, it can't get dipped into as well. So once it's there, it is genuinely out the way for the benefit of them. We've just got to hope when they hit 18, they'll be sensible enough to do something with the money. I've talked about this on a podcast a month or so ago. I'm just going to intercept the letters before Hazel and Chester get them. I'll just keep them and not tell them. I think I'll just fold them into another ISA because, I don't know what I would have done at age 18 when I probably got, 20 or 25 or 30,000 pounds or something like that. would have been party time. I think it's obviously I've put that aside for the kids for university, but I think if I was 18, it would have bought a car. getting a really, really good car at that type of age as well. And Greg, it was nice of you to mention that you're creating an account for me, George, Steve, and Jamie as well. So we're all, with the exception of George, we're all a little bit too old for a JISA, but a normal ISA will do, nonetheless, Greg.
Yeah, well, obviously with our minimum investment levels being £1, you've each now got a general investment of £1 each.
Yeah, £1's better than what I started with at the start of this podcast, mate. So
there you go.
I've made a profit. Aye. And Jamie, the question on nobody's lips is: have you created your JISA yet for Jack?
No, actually, that's the one on my list to do today. I've been thinking about, because I think it's important to understand, as you said, how you want to set it up. So I'm going to set up a JISA, so he's got a little bit of money when he turns 18, but also probably set up a different savings account for money that I can control. So I think I think the JISAs are good for a couple of things. Yeah, they're good for parents to set up. They're actually pretty good for grandparents. And also, it's a way of getting £9,000 a year out of your estate. If you're looking to sort of gift to your children at some point in the future. But it's actually I got a little bit of a telling off yesterday about getting it done actually by Annie, my wife. So
well, you've had 2 weeks holiday.
I know.
Bad father already.
Don't worry, you'll definitely be getting some savings in there. There's no doubt about it. Just the problem is, it's one of these things, isn't it, where you have to advise yourself. It's a little, you don't rush to it.
Well, I think sometimes the problem is you can know too much.
Yeah,
you kind of get it's something called the choice paradox, where you kind of get crippled by having too much information.
Yeah,
so you can't actually make a decision. So there's a bit of learning for you on a Friday morning.
Yeah, God, it's too much for someone that's had 3 hours sleep.
3 hours is good, man. That's all right. George, we'll jump to you, because you've been laughing away quietly in the corner there. I've been watching you on the video. I think you obviously mentioned a lot of this in your introduction, George, already, but I think some of the points were nice to repeat. And there's a question from Martin and a question from Kerry, which are both linked with the second lockdown, as they've both called it here. Martin's asking, how do we make sure investments aren't concentrated in the UK? And Kerry is asking, how will a second lockdown impact markets? So I think they're both reasonably well linked there, mate.
Yeah, so starting with the first one, I think, the ethos of the True Potential portfolios, Dan, is really diversification. So we partner with some of the biggest investment houses in the world to gain exposure, not only to a range of different asset classes, but geographical regions as well. So it's a truly global proposition. So to put that into context, if we take, say, the balanced portfolio as it currently stands, you've got around 10.5% in UK equities, you've got around 3.5% in UK government bonds, and 5.7% in UK corporate bonds, with the remaining amount being invested across other equity markets such as the US, Europe, Asia, Japan, and the emerging markets, and even different asset classes. So a range of overseas government bonds, a range of overseas corporate bonds, alternatives, listed real estate, and even precious metals such as silver, gold, and platinum. So you're not held at the mercy of the UK market here. But it's a great question, and I appreciate the focus of the question is the UK there. But in addition to that point on diversification, what makes the portfolio proposition very effective is the active nature, meaning at portfolio level, we can make adjustments to the exposure to certain asset classes and regions by tilting the exposure to certain managers through rebalance. And under the bonnet and on a more frequent basis, those managers are also active in their positioning of their funds for the best risk-adjusted opportunities. So what we're doing there with the proposition is we're taking away the issue of being overly concentrated through diversification, but we're active, which allows us to lean in or out of certain markets depending on the opportunity set there. The second question is an interesting one. As mentioned at the start there, we didn't get the full lockdown which markets were expecting. That sort of scenario, if we think back to the start of the week when that anticipation was there, you had the FTSE 100, which came off around 3.4% on the day. The areas most impacted with that anticipation were leisure, hospitality, industrials, those things which are really linked to consumer footfall in economic growth. You had marginal sterling weakness against the dollar and the euro. Caveat, there's two sides to currency pair in there with other factors weighing on it. But bonds were little changed over the period, which is interesting. What we're saying there is it will, of course, have an impact on certain areas of the market, more so than others. But the situation now is very different in the sense that, coming from the first quarter, a lot of businesses are better equipped to operate under social distancing requirements, having invested heavily in technology. We've received reassurance from central banks that they have not used all of their armory up, so there's still liquidity in the system as they continue to keep buying bonds from the market, which may in turn talk to the relative calm which we've seen there over the week. But it's important to see that whilst we are seeing a pickup in cases, and this is driving the movement which we saw going from a full lockdown to a sort of a lockdown light system, we've seen testing picking up. That's not translating into uncontrolled levels of hospitalizations and deaths. Therefore, the government are using restrictions on activity to curb the increase, which is preventing the need where possible. They're not taking off the table the need for a secondary lockdown. So although it's not great, the reason markets did stop and take a sigh of relief is because it still allows a lot of business to operate, albeit with restrictions. So it may slow the pace of progression, but it's not pulling on the handbrake. So that's one way of looking at that approach, Dan.
Yeah, no, I agree as well. It's more like to use another Boris Johnson saying, it's like pumping the brake, isn't it, rather than pulling the handbrake, to use a George Bell expression. So you do a better job than Boris as well at the minute, George. You get my vote. Honest George for government.
Got a better haircut.
You do have a better haircut, mate. It's a lot failure. Jamie and Steve, last question for yourselves today, and it was one, Jamie, you kind of referenced earlier when you were talking about JISAs, and it's a great way to be able to leave some money or start getting some sort of inheritance tax planning or estate planning in there. But we've got a question. It's from a couple. It's from Inns and Maureen, and they're saying, how can we leave our pension to our 5 grandchildren?
Oh, interesting question, Dan. The great thing about the interesting thing about pensions now, obviously, you can just nominate your beneficiaries. So it doesn't have to always be your wife or your children. It could be your grandchildren. So if you on your website, you can actually set up your beneficiaries. There's directly there, or as Greg said before, you can contact the team via secure messaging, and you can set up a beneficiary route via them. You tend to find if you've went through the process with us, in terms of whether you've been advised or you've chosen to sort of transfer of your own accord, we do actually ask them questions, so you potentially set them up already. But just give us a call or secure message, and we'll check who they are for you, and we can reset them up if you need to change them. It's really important, actually, because when if something does happen to yourself in terms of looking at where that money goes to, if there is no beneficiaries, that is at the discretion of the trustees of the pension. So by you telling us who you want that to go to, it just makes it a lot easier for when we are actually sort of dispersing that fund. The other thing I would say as well is that it doesn't necessarily, on death, you don't necessarily have to just get a cash lump sum. Many will just set up a new pension and then that own the beneficiary. So for example, in this one, if you had 5 beneficiaries, that could be 5 different pension pots now in place for them 5 children. So it's always something to consider, and making the beneficiaries aware that you don't necessarily have to just take the cash, which a lot of firms actually do.
Yeah, I'd add to that, Jamie, in the sense that I think everything you said there is correct. I think in answer to the question as well it refers back to our previous answer. You need to have advice when you're looking at your estate planning. Pension freedoms have given a lot of people assets that are over the IHT allowance. So it's money very well spent consulting your advisor to talk about how you plan your estates in the event of your death. But don't leave it till the last minute. I know you can't predict when death's coming. It might not. It's probably after a night out in Bradford and a curry. I think it's coming relatively frequently. But give yourself time. Talk to your advisor and get your estates in order, because again, you will miss valuable tax allowances. And also, as Jamie's outlined, you want to leave it to the people you want to leave it to. So make sure you talk to an advisor. It's well worth the cost of advice to have that conversation, and don't leave it too long. My advice.
Yeah, thanks, Steve and Jamie. So I agree, and we do see it a lot less often now, but we do see the odd pension still get loaded onto our system at the beneficiary, and it's just one extra box on the application form. So it's very well spent. And a couple of my senior partner colleagues are on our pension committee, and so I know from speaking with them, it's messy if there's not a beneficiary on there as well. So something which is so simple makes it a lot simpler moving forward as well. Greg, there's a question which was gonna be for Steve and Jamie, but I'll give it to you because it's from Stuart, which was, when can I afford to retire? And I just wondered if Greg, if you could just spend a moment talking about the app and the goal side of things, which will hopefully give someone like Stuart a good indication of when he can indeed afford to retire. But that's linked then with a question from Mark, which is, how can he invest when the market's depressed? Which is a great way of, I suppose, being able to bridge the gap to goal in there.
Yeah, absolutely, Dan. And that's the word you've said there, the gap to goal and goal-based investing. And the beauty of the website is it first of all gives you today's valuation, which means we can then forward look and forward project potential retirement dates. And we also have a good bit of technology called True Potential One, which starts to do some lifestyle planning. So working with an advisor or a member of the team, we can start doing some real number crunching to say, if you were to retire on this date, and as Jamie said, maybe take 1% of your pension to start drawing an income, we can start plotting this out and drawing it up. I log in most days, not every day. I'm not quite like Jamie, who probably logs in every hour. But I log in probably every other day. And I actually rarely look at what today's value is. What I normally look at, Dan, is the gap to goal, because I've set a goal for where I want to be in the future. I'm a little bit away from retirement yet. I think I've got many decades left to go, I think, before I'm able to retire. But now's the time that I'm looking at my retirement, because now's the time I'm able to add money into my savings, my pension, so on. So the first port of call, I would say, for all clients, but especially if you're looking to retire, is set yourself a goal. How much income do you want to live off in retirement? What are your current expenses? What will your expenditure be in the future? So by what year would you have your mortgage paid off? And we can start drawing these up. So we really do have some cutting edge technology that can start planning some of the sort of life cycles, really. So obviously being in accumulation, building up wealth, but also we're equally, cautious with the decumulation. So as we've talked about, not taking too much and creating yourself a tax problem for no reason, but at the same time making sure you've got sufficient income to retire comfortably, which is what we do at True Potential. So I think on that question, it's a case of work with your advisor or work with a member of the head office team to talk through your policies, but do always keep an eye on that goal. Too often do people look at the stock markets, as George has mentioned there, some scary figures of what the FTSE can do, for example, but that's just an indicator of one market, not the performance of your funds, nor is it an indicator to your goal, which I think is probably the most important thing. As we talk about investing on the sort of accumulation side of things, for me, as I mentioned earlier, I've got True Potential products. I've got a pension, which I pay a monthly direct debit into. And what I like about that, it's just the pound sort of cost average, and that comes into the policy of, just a regular contribution, continuing to top it up. So if there is a slight drop in the market, I'm not concerned, because I know I'm buying more units. If the market goes up, then obviously I'm equally as happy because I've got more units grown at that time. Then when I look at my ISA, what I do with that is I just impulse save. So when I'm on the go, say after this call, I can have a look at the market. I can have a look at my bank account. If there's any money left over, I can just top up. And I think impulse save along with a monthly direct debit works really well for me. So I can log in, I can see if I'm 20, 30 pounds behind my goal or my target, log in, top up, and that takes, no more than 20, 30 seconds from my bank account straight into stocks and shares. And that really does work for myself.
Thanks, Greg. I think probably just to follow up from that, really, because you've mentioned some great features of the app today, which I know I sometimes take for granted a bit, and I think probably some other people do as well. I'd really recommend logging into your app after listening to this and just having a play with it. Just have a walk around it, have a look at secure messaging, have a look at where your documents are stored, have a look at your goal. Is it set? If it's not set, you can add one there and then as well on your app or in the site as well. It does a lot of things, but sometimes it requires just, our users to get in and have a bit of a play with it. And one of the things, Jamie, which you and your CAP team do, the Central Advice team, and they offer live demos to clients as well. So if anybody's ever struggling, the team will screen share with you and walk you through your own app as well. So just something really to take away there, everybody. George, last question for you, and then we'll wrap things up, gentlemen. It's a Brexit question, George. We couldn't do a podcast without mentioning the B word. We talked about a bit of this last week, I think, when Mark Henderson was on, when we were saying how will markets react if the government breaks international law. That's a question from John. So I think with obviously John there is referring to the UK kind of overriding the UK internal markets bill, which we talked about last week from the EU withdrawal agreement. So I think some of that was already baked in, George, and kind of thought about, but has there been much else this week with that?
Yeah, I mean, blimey, what a question. I was going to ask if there's a shuffle option on the questions there. I think it's difficult to quantify, Dan. I imagine, I would imagine it would have an impact on sentiment of UK assets without going into detail of loopholes and clauses and so on. There would be a perception that it would be going against agreements, therefore it would increase the required compensation which investors are looking for in the UK market, or risk premium, as it's referred to. So, if we think back to, let's think back to the day in which that was sort of unveiled and markets started to talk about it. That was the 8th of September. Sterling fell around 1% against the dollar. So overall, I think markets would be seeking, or investors would be seeking greater compensation to be there. So it talks to, again, nature of the portfolios in terms of the insight which our managers have in terms of how businesses are planning for this type of event. They're active in the nature. But for the portfolios, it's, as I say, I mentioned the weightings which we have in the UK market. Just remember, you're in a diversified investment solution here with active managers there. So that's my political answer to a tough question there, Dan.
No, it is a tough question, George, but I think you're absolutely right. It's one of the reasons why we do bang on about diversification a lot. It's not just about the United Kingdom where your money's held. It's about the world. It's about different asset classes. It's about different currencies and everything in there as well. So, perfect. I think we've answered every question today, which is a world record for us. So thank you, panel, for keeping me on track with some great answers there. And hopefully, ladies and gentlemen, you've got some extra kind of things to think about and things to look at off the back of today. As I mentioned at the start, thank you so much as well for contributing with the questions. We'll probably run another one of these in about 4 or 5 weeks' time as well. So before we wrap up, any final thoughts from anybody? Any other pearls of wisdom or bits of knowledge to share? No.
The silence,
No.
the silence,
Golden.
silence speaks, doesn't it? Dan,
Yeah.
I would just echo something that Greg said, and we speak to clients quite about this, but don't underestimate the power of long-term regular savings. It can really, really support your goals. So rather than think, oh, I need to put a lump in now and then put a lump in the future, just long-term regular benefiting from that pound cost averaging is really effective. And you typically do it automatically in your pension if you've got an auto enrollment pension. But doing that in ISAs, it really does add up very quickly. And if you're not regularly saving, and it's something where at the end of the month you've got that little bit left in your bank and you're just building up your cash reserves, I would seriously think about it. I find for me, I put a certain amount away a month, and I just treat it as a bill. It just looks like a bill at the end of the month. But the benefit of that is, as Greg says, is when I log in 3 times a day, it's very effective. It really is really powerful. So my view is just don't underestimate that. That's a great way of saving.
Thanks, Jamie. Yeah, I think that the direct debit's a good one because I have a direct debit set to go into my general investment account, and it comes out on the first day of the month. So it comes out the same day as my council tax, my electricity bill. So it is. I just it's away. And then you're right. It's a nice surprise. Then when I log in, I log in about once every 2 weeks, Jamie. So just for reference. Steve, are you going out? Are you going out to Bradford tonight, Steve, to bring Def on with Korean lager?
Yeah, I'll be back down to a different local lockdown. We talked last night about local trumping national lockdowns. Yeah, I'm going home for that. But I will. My point would have been just that, everybody. The markets, there's volatility coming back now, and you only have to watch the news to know that we're not in normal circumstances, both with the health crisis and what's happening in markets and Brexit and everything else we've talked about. So keep your nerve, everybody. Please do not make any rash decisions. Stick with your advice. Keep your goal in mind, and don't do anything silly in the coming weeks and months. And don't do anything silly and come to Bradford is what I would say. Stay away.
Yes,
stay safe.
That's Bradford's all yours, Steve. It's all of you.
All mine.
George.
This weekend I'm going up to Kielder on the bike. It's about 26 mile. I did it the other week, and it's quite a nice ride, quite a nice track round. So that's what I'm doing this weekend. In terms of pearls of wisdom, I think your point there, Dan, of explore the app, see all the features. Within there, if you go into the app, you'll be able to see where you invested, which portfolio you're in. You'll be able to see the asset classes, which will expand a little bit around that point I was making earlier on around diversification. You'll be able to see the managers which your money is invested with. And you'll also see some commentary in there, which will tell you the tilts that we've been making. So back to that active management side, you'll be able to see the way in which we've been making adjustments for you within your portfolios on your behalf in response to the environment which we see. So that's my top tip.
Good stuff. Thanks, George, and good luck with the Kielder route. I've done that cycle before. It's deceptive because you think it's flat because it goes around a reservoir, but it's not. There's some hills there.
Yeah. I did it a few weeks ago. You get to the point where you think I'm halfway, and you realise you've only just turned the first corner. So you've got to get your energy levels up and go for it. But I look forward to it.
No, some more hardcore people run that, don't they? And do the Kielder marathon. And one of my friends ran it a few years ago. It's the worst marathon he's ever ran because he just says it felt like it was just uphill the entire run. So.
I passed a few people doing it last time, and they didn't look happy. It started raining. I was going to offer them a lift, but they looked too upset for that. I just thought,
it's always raining and cold in Kielder, I find. It's just, yeah. And Greg, are you going to Kielder this weekend?
No, I'm not. I mean, I was going to say pearls of wisdom, but all of mine have just been, rehashed there by the other panelists. So I'm glad that was all picked up on. I dare not say what I'm up to because I know fine well this will be listened to by a lot of my colleagues and I'll be judged on it. But 2 rounds of golf for me booked in this weekend. So for previous listeners to the previous podcasts, David and others basically don't like the thought of me playing golf. So I'll leave it at that one. So yes,
it's not personal, Greg. It's not the thought of you playing golf. It's just the thought of golf, mate. It's not our corporate sport.
It's not. You're right on that one. Definitely,
Yeah.
yes.
I'm not sure what our corporate sport is, but I know it's not. I know it's not golf anyway.
Yes, I definitely know it's not golf. That's
No.
right.
Well, great. Well, we'll get off here, gents. So thank you so much, Steve, Jamie, George, and Greg. Really appreciated your input and your great answers today. So thanks, lads, and enjoy your weekends. And ladies and gentlemen, thank you again for the questions. Thank you for listening. If you like this, please press like. It really helps. And if you haven't already, please also subscribe to our channel as well. We really appreciate it. Thanks, everybody. Have a great Friday. Have a lovely weekend. And looking forward to speaking to you next week. Thanks. Bye-bye.
Thank you.
Thanks, everyone.
Thank you.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.